Good morning, everybody. Marty Mazur, July 10th, 2018, Tuesday. I thought I'd just pop in for a minute this morning and share with you what I was just looking at. I'm just kind of updating my state of the correction chart. And again, by definition, we have been experiencing what would be a correction. In my view, somewhat of a garden variety correction, although it was certainly precipitous between January 26th and February 8th. But since then, it's been kind of following the path of your average 10+% corrections when we look back at them throughout history. As we talked about here, the average duration is about 209 days, which if we fall right on the average, it would be late August before we get back to all-time highs. Of course, a lot can happen between now and then. It would be miraculous if it falls right on the average. So we could see the market accelerate, get to all-time highs faster, but we could see it take considerably longer. We're operating under the assumption, though, that we are still in a bull market because that's what the data, both fundamentally and technically, tell us about the present market environment. And until we see it differently, we anticipate, again, that we'll get back to where we were and some, while the setup remains as it is today. We have offered up our concerns and illustrated those, talked about them a lot over the present state of trade in the world. We think it'll be difficult, a meaningful advance, while we still have this weight of a potential trade war on our shoulders. The rally yesterday and today, I think, is just simply the fact that no news is good news. So, folks, just be prepared for more volatility because clearly neither side is willing to concede at this point, and it may be some time before they do. But I wanted to show you what I did this morning and layered on a few more technicals. So, again, here's that downtrend that met with two areas of resistance, struggled with it just briefly there, and then broke above and began a new intermediate term, short to intermediate term uptrend. And that's where we're riding. You can see we tested it, succeeded, and now I could draw a line right here and say now we're going to test this resistance right here, which we are currently as I speak to you here this morning. Okay, so other things that I like to look at. In some of my commentary or our commentary, I'll talk about volume. I like this particular very simple indicator very much. This is called unbalanced volume, and that's this line here. And what this essentially measures is the volume on a day-to-day basis, total volume, and it accumulates it. And it sends the line up to the amount that we had volume that day, the number of shares that traded hands, when in this case, the S&P 500 index closes higher than it did before. It sends it down when it closes lower. So the idea there is to measure where the conviction lies. Obviously, if we have huge volume on the down days, that would suggest that sellers were much more passionate than buyers. If we have huge volume or bigger than average volume on the up days, it would say the opposite, that buyers are more passionate and they're pushing prices higher. As you can see here, while the market or the S&P 500 established this downtrend after this correction here, you can see that on-balance volume continued to show what we would say would be accumulation. This would suggest that there's been more commitment on the side of the bulls to buy the dips and push stocks higher. We've had more volume on the up days on balance over time than we have on the down days. Another indicator that I like very much is a measure of breadth, and this is the advanced decline line. As you can see here, the advanced decline line has also continued its upward track. In fact, this is now at an all-time high. Now this measures the advances versus decliners, the actual number of shares, in this case within the S&P 500, on a daily basis, and then adds that to the line. So what we've seen here is we've seen a real, again, precipitous drop in the market. We did see the AD line come down a bit, but as we've worked our way out of it, the advanced decline line has actually moved to all-time highs. So even though the S&P 500 index, which is capitalization weighted, meaning the bigger stocks have a bigger influence on the index, the actual number of stocks going up versus going down is actually continued to rise. And again, it's currently at an all-time high. So this suggests that the overall breadth of the market is actually quite strong. So even though we're still in a correction, we still believe there could be notable, if not extreme, volatility to the downside. This particular indicator that suggests that more stocks are actually advancing than declining on average over the course of this correction speaks volumes about the underlying strength of the market. And this is one of the things we need to pay attention to as we consider future allocation adjustments in client portfolios. So in summary, conditions both fundamentally, as we stated in our weekly message on Monday, and here technically, as I'm illustrating for you today, says that we are very much still in a bull market. The volatility that we're experiencing right now for long-term investors is volatility to ignore. We do have our concerns. We'll continue to express those on the blog so you know what we're thinking and why we're doing what we're doing. But until we see conditions really break down and show us signals that probabilities favor a recession and a bear market, we're pretty much going to stay the course aside from some what we believe is smart tweaking sector by sector. Thank you, as always, for watching and listening, and we'll be back soon. Take care.